Netflix beat earnings expectations as the streaming giant added nearly 9 million paid subscribers, helped by its password sharing crackdown and cheaper ad-supported tier. The company is also flexing its pricing power, hiking fees on some plans as early as this week. Joining us now is Michael Nathanson, Nathanson, founding partner and senior research analyst. Michael, I was just saying here on set during the break that there's 4 things that are important when you're the parent of a 20-year-old. When they come off your health insurance, when you stop paying their cell phone, when you stop paying their car insurance, and when you stop sharing your Netflix password with them. So what's going on here? Am I going to not be able to do this anymore?
Well, you're going to be able to do it. You have to pay more to do it, right? So what Netflix has done is they said there are 100 million homes around the world where people are sharing passwords. We've done research with PCH that says, to what your point is, Steve, the vast majority of sharing are parents and children. And at some point, your kids are going to be outside of the home. They're going to have to basically pay for their own password, or you will pay for it. So we're about halfway through that process right now. So we think there's another 2-3 quarters, and then a lot of that password sharing will either be paid for, or people will just not use Netflix at that point.
If I showed you the family text group that I have, half of the conversation is, what's the so-and-so password? That's all we ever talk about here. It'd be nice if they asked how I was doing once in a while, but they really just want the password. So you're saying we're halfway through that process. The 9 million subscribers they added in this last quarter, how many of that do you think came from the password sharing efforts here?
Okay, they've not said, but again, the research we've done with PCH suggests about 20 to 30% conversion of 100 million. So I would say we're probably about 10 million of that way through, right? So basically think 5 million last quarter, 5 million this quarter, 5 and 5. So that's how we think about it. The company's not saying, I think the question people have is, okay, 12 months from now, what's going to happen to this crackdown? Will it just start not mattering at that point in terms of subscriber growth?
So at some point, right, you do lose some viewers. Does Netflix not care about that? And all it really cares about is paid subscribers?
Yes, what they're counting on is that new ad tier. The price is so low that at some point people can say, okay, what else is on right now? For $6.99, I'll take this product. It's really cheap relative to other options. I think opening up that price point has given them more confidence to raise prices and to start pushing people who are password sharers. So I think that's been the big change the past 12 months, is they have a very low price point that they think will catch people who are either price sensitive or just angry about price hikes.
All right, one more quick one here. Are you ultimately upbeat here on this? Is this something you think there's room to grow and they're going to surprise us again? And how surprised were you with these earnings?
Okay, that's a good question. We were most surprised about the price increase, right? They raised prices in the U.S., UK, and France pretty aggressively right now. There's still a strike going on, right? We didn't think they would do that until the strikes were over. That was the biggest aha for us, is that they really are flexing their pricing muscle. In terms of where you're on the stock really got crushed after a conference where the CFO spoke a month ago. It's back to where that level was before. We're neutral on it. We think Disney, because it's been, to your point, on 8-year lows, or Mike's point, that's to us a name people should be looking at right now, because it's really just been hammered. There's no investor attention or love there. That to us is a really interesting idea for the next 12 months.
Yeah, Michael, let's get into that because, there's a lot of ways to frame even the ESPN financials that they came out with, I guess, on a 9-month basis. It wasn't a big precipitous drop in revenue at ESPN, kind of broadly defined. But how do you think about Disney in terms of being able to be agnostic about how people consume their content and also the overall spend? One of the things I've been wondering about during these strikes is, are all these companies coming around and saying, maybe we don't need as much? Maybe in aggregate, we don't have to give as much new stuff all the time, and therefore we can kind of get by in a more profitable way on streaming.
Right. I think it's a great point, Mike. To Steve's question before about the aha in the quarter, Netflix only is going to spend $13 billion this year. Only 13. Yeah. We thought they'd spend 15 when the year started. And I think what people are missing about Disney is that they overspent the way Netflix did to build their business. And now they're realizing that perhaps we could spend less. We could, stretch out some of the content. We can make less regional content. And I just think, what you're seeing is the strike may have been a a silver lining in the sense that people have now realized they could slow down their content spending, right, and start to drive margin. Also, they can drive pricing because there's ad tiers. So I think for Disney, the opportunity is really about their streaming profitability. Netflix is going to be in the 23% margin range. Disney's negative. So just get me somewhere closer to Netflix or halfway there. And Disney has a lot of upside in terms of earnings power.
And in terms of the ESPN financials, is that just kind of a signal to say, look, this business is still viable, it's not a fire sale, or do you think that they are really prepping some kind of strategic investment into that business?
Well, I know on the strategic investment side, they're out there talking to leagues and distributors. They've been clear about that. They talked to some of the leagues and some of the major digital distributors. So I think that's the plan. What surprised us in last night's release was the non-ESPN networks were much worse than we thought. And I think, if there's an opportunity, look, we're not bullish on linear networks, but it's, they need to drive profitability there. They need to reduce their spend, cut expenses. And to me, we were like, wow, the ESPN businesses was not as bad as we thought. The top line was more stable. So we think there's an opportunity also in linear margins to be better, ESPN, I think when this whole thing emerges, it'll probably be seen as probably better than people would have thought. With all the noise and all the furor, it's not as bad as you probably would have thought.